Something crazy that's happened to our society over the past few years is that $50,000 is becoming the going rate for a brand new car. It's becoming the new normal. And the big question mark is, how is everybody paying for these $50,000 cars? Because it really wasn't that long ago that you could actually buy a house for $50,000. In fact, there's probably still some areas of the country where you can buy a completely beat up house in the ghetto for $50,000, maybe even less. Now, is that comparable to a brand new car? Not really. But the point is the same, that same amount of money can get you something drastically different, gets you into home ownership versus just buying a brand new car that's going to lose 20% of its value the moment you drive it off the lot. Brand new cars right now cost about $50,000 on average, and the price of a 3-year-old used vehicle now is a little over $30,000 as of the first quarter of 2025. And then, of course, you have high interest rates, especially when it comes to getting a car loan. The average interest rate as of May of 2025 for people who want a brand new car loan for someone with a credit score of 750 or higher, they're looking at an 11.38% interest rate. The average interest rate for a used car loan right now is 11.63%. These rates are insane. This is a situation where I would definitely say that the interest rates could make a sizable difference in how many people are buying these vehicles versus where the housing market, the interest rates are at historical averages. But 11% to pay on anything, especially a $50,000 loan, is just too much, guys. But the fact that these cars even cost 50 grand to begin with is also a joke. So what are people doing to afford this? Well, people are doing a multitude of different things. Some people are opting for longer loan terms, which is something I've discussed before. Now it's very common for people to extend car loans. Instead of having 5-year loans, they're going for 7-year loans, 8-year loans, sometimes even longer. The typical range is 36 to 72 months. That's a 3 to 5-year car loan. Now you're looking at 84 to 96 months. So I mean, a 7 or 8-year car loan, by the time that car's paid off, you're going to need a new car, maybe even before that, especially if you drive it a lot. In fact, take a look at this. In the first quarter of 2025, about 20% of consumers who financed a new car loan opted for an 84-month loan, which is at an all-time high, according to Edmunds. So these people are getting a 7-year car loan to afford it, guys. 7 years. Like, in case you haven't noticed the direction of everything when it comes to financing and affording all these things, homes, cars, whatever, big ticket items, is that the financing terms keep getting extended. There's been whispers about 40-year mortgages in the housing industry. And if you have an FHA loan and you fall behind on your loan and you are looking for some sort of loan modification, you can actually get a 40-year mortgage on your house right now. But really all this means is that people can't afford the houses or the cars that they are buying. Also, in the first quarter of 2025, about 18% of buyers have a monthly car payment now of $1,000 a month or more. This number continues to just go up. Of course, another way that some people are affording these car loans is they're trading in vehicles, and depending on the type of vehicle you have, you might be able to get a pretty decent trade-in value because some vehicles have higher trade-in demand than others. But a big way that a lot of younger buyers of these vehicles in particular are getting help is from family members and co-signers. Younger buyers are getting help from their parents when purchasing a car. It's not only are mom and dad helping to buy the house, they're also helping to buy the car. Parents are offering up cash to cover the down payment or even the monthly payments in some cases, or parents serve as a co-signer for some people on an auto loan. And having a co-signer can help you land a better loan term, which results in lower monthly payments. And being a co-signer on a car loan is never a place you want to be, because there is a high probability that at some point down the line, you're going to be the one making those payments. And then, of course, a lot of dealerships right now are offering up huge discounts on brand new cars. They're offering up employee discounts, essentially selling vehicles to end consumers for the price that their employees would pay. And you're seeing some vehicles being discounted by $18,000 or $20,000 or more in these cases. But it's still too expensive is the point, especially at an over 11% car loan. So of course, a lot of people instead, they turn to buying a used car, since most people cannot afford this $50,000 price tag for a new car. But, that gap between a new and used car is shrinking. Like we talked about earlier, you got $50,000 as the average price of a brand new car, and then you got $33,000 as the price of a 3-year-old used car. Yeah, it is cheaper, but it's not that much cheaper, especially since people finance stuff anyways. They're not pulling out of pocket for all that money up front. But one of the best ways to get a good deal on a car is, people used to just drive down the street and look at the car lots and see what they have in their local area. But with the internet nowadays, you can search for a new or used car for that matter nationwide and end up getting the best deal that way. It is a lot more difficult. Sometimes you have to travel to go get the car. And if you're buying used, especially, you don't really know what you're getting until you get there and maybe test drive it and take a look at it. So there is some risk involved with this method, but it can save you thousands of dollars as well. But you know how most people are handling this situation right now? They're just not buying a car. That's right. A lot of people are saying, you know what? I'm just going to drive the one I have until the wheels fall off. I did a whole video on that, I don't know, 6 months ago or something. Most people cannot afford these prices, and it's a great way to actually save money if you have a car that works perfectly fine right now and there's no actual need to get a new one. Then waiting and driving that car till the wheels fall off can be a very smart financial decision for many people. Other people choose to live in areas where you don't even need to have a car, or you do rideshare services, or take public transportation, things like that. Personally, I could never imagine living my life without a car. Even in Miami Beach where I live, technically you could live there without a car. You could just get around with public transit and a bicycle, but it definitely wouldn't make life easy if you're doing it like that. The only benefit to doing it that way, in my opinion, is that you're avoiding traffic, because now we have a boardwalk in Miami Beach that goes all the way from Surfside down to South Point Park. So you can basically ride a bicycle anywhere and you can avoid the road the majority of the time. But it takes longer. You're exposed to the elements. You want to do something like grocery shopping and do a big grocery haul like my wife and I do once a month. That's out of the question. You're only stuck with doing, a small grocery haul. You have to do more frequent visits. But in order to save money, I think it's a great thing to do, especially if you're saving $500-600 a month on a car payment. And something else that's happening to people who have cars is their insurance rates are going up. In fact, one of my viewers here from California sent me his most recent insurance figures on how he got an increase, even though he hasn't had an accident, he hasn't had any insurance claims or anything like that, but yet he's still getting an increase. He says, I drive 1,900 miles per year. I take the metro to and from work, no claims in the past 7 years, but my auto premium just surged by nearly 20% year over year. So drivers like him are getting punished for what other people do and for natural disasters, because we can't have a world where insurance companies don't make a profit. He says he's never had a claim on his renter's insurance policy. That also went up 14%, likely due to the Southern California wildfires, because State Farm is crying poverty. That's what all these insurance companies have been doing lately, crying broke, even though they're producing record profits these past few years. And he wanted to send this over to me because he wanted to point out the fact that even though you have people who are extremely low risk from an underwriting perspective like him, zero claim history in the past 7 years, low mileage for driving, also zero claims on other policies, and people like him are seeing their rates skyrocket right now. And these kind of situations make you wonder if insurance is even going to be available or viable in the next couple of decades, because if it keeps going up at the rate that it has been going up, a lot of people aren't going to be able to afford insurance. That's the reality. And the ones who can are probably only going to be the wealthy. But what happens when insurance is a requirement and most people can't afford it? What do you do then? Are these insurance companies going to put themselves out of business because their premiums are too high and they're losing too many customers? Or are they going to be forced to lower rates? One thing they've been doing is they've just been keeping rates the same in many cases, or lowering coverages for a lot of people. So you're still paying for it and you're still complying with the law, but you're not able to actually have any real coverage in the event of something actually happening. And going back to car insurance, that can be another great reason to drive the car until the wheels fall off, because in general, you're probably going to pay a much lower insurance premium just having basic coverage on an old car where you don't have full coverage anymore, versus being forced to pay for full coverage on a brand new car because you have a loan. Because one thing a lot of people don't realize also is that if you finance or lease a brand new vehicle, you have to have full coverage insurance on that vehicle. And sometimes the liability limits need to be really high. Like when I leased my first Jeep, I think we leased it back in 2019. And the lease term stipulated that we needed to have $300,000 of liability coverage in order to be in compliance with the lease. And I had never seen anything like that before. And I was kind of surprised because I'd never had anywhere close to that amount of liability coverage prior to then. I think I only had like 50,000 in liability coverage. So of course, had to pay significantly more for that. The only thing that worked in our favor is that I was already older, so I wasn't like a really young driver anymore. And since it was a brand new car, it qualified for a lot of the safety discounts that my old car didn't. So there can be some advantages there, but in the end, it still costed more. And I was reviewing some of the comments in the video I did the other day about the top 5 things that people waste the most money on. And I saw a lot of people saying in there, wow, I'm surprised it wasn't cars or houses. And actually 3 out of the 5 items by people's own admission was food, going out and throwing food away and impulse buying things, especially food and convenience food, stuff like that. Well, in my opinion, you can add insurance to that list as well. It's a huge waste of money because you can't really use it unless you want to see your rate go up or have the potential of getting dropped. That's how all insurance is leaning towards right now. Like, you get punished for making a claim on your insurance. Even just calling the insurance company and asking them questions about what if this happens or what if that happens can already be counted sort of like a claim in their database against you. Anybody who needs another reason not to buy a brand new car right now for 50 grand is the layoffs. Intel, right here in the Bay Area, just announced a 20% of its factory workforce, cutting 10,000 jobs worldwide, okay? They're gonna be laying off between 15 to 20% of its factory workforce beginning just in July of this year. So in a couple weeks from now. This is going to eliminate over 10,000 jobs globally, which is one of the largest workforce reductions in the company's history. These layoffs are going to impact Intel's foundry division, which spans from technicians on production floors to researchers developing the next generation of microchips. Here in the United States, this layoff is expected to weigh heavily in Oregon, which is home to about 20,000 Intel workers. And a lot of this has to do with Intel falling behind other chip makers like Apple and Nvidia. In fact, Intel posted an $821 million loss in the first quarter of 2025, and they've been steadily reducing their headcount since 2023. Here's what the new CEO of Intel has to say about this. I'm a big believer in the philosophy that the best leaders get the most done with the fewest people. This sounds like another push towards AI. Another situation where they found robots and AI and machines to replace a lot of the people that are going to be doing these jobs, most likely. They didn't have any mention of that here, but you know for sure that that has a lot to do with it. And unlike some of the other tech companies, these people who are getting fired from Intel are not going to get buyouts. So basically, you're going to get a warning and you're going to be done. That's it. Even Chevron in Texas announced some major job cuts coming here very shortly. They said they're going to be losing about 200 positions in Midland, Texas by July 15th of 2025. And they are targeting a 15 to 20% reduction in headcount of up to 9,000 employees by the end of 2026. What are they doing? They're trying to simplify their operating structure, increase execution speed, and maintain long-term competitiveness. The same thing that every single corporation is trying to do right now. And what are they doing to achieve that? They are using a combination of machine and AI to eliminate these jobs. They are keeping productivity the same, sometimes even increasing productivity while eliminating employees. That is the trend, guys. Anybody who saw my video I did a week or two ago about this, with the AI CEO. He pretty much came out and admitted that's what all these AI companies are doing. There was no hiding the truth. He admitted that's exactly what they're doing, and people need to be ready for it. We could be looking at a 20% or higher unemployment rate just in the next few years because of AI. Chevron, on the other hand, though, they are offering severance and transition assistance, but the scale and cadence of layoffs across California and Texas highlight just how deep its cost-cutting agenda runs. In other words, you haven't seen anything yet. The layoffs are going to continue to get worse and bigger as AI becomes more ingrained into our everyday society. This is why I've always told people, since pretty much I started making these videos back in the day, that you should be investing in gold and silver, because that's something that the government can't print. The value of these commodities has exploded over the past 5 years, like every other asset has. And even Costco started selling gold bars a couple of years ago, for anybody who remembers that. So how much money would you have if you would have bought a gold bar from Costco just last year? Well, let's take a look at this. Recently, these gold bar purchases have gotten so popular at Costco that they've actually had to limit the member purchases to one transaction, capped out at a maximum of 2 bars per day. That's the maximum any Costco member can buy right now. So as of Tuesday morning this week, gold was trading at around $3,400 an ounce, which is near a record high and about 45% higher than it was at this time just last year, guys. 45% higher. While the stock market, on the other hand, is just lucky if it's recovered to where it was from a year ago right now, let alone increase 45% from a year ago. So if you would have purchased a 1 ounce bar of gold at Costco in June of 2024, you would have purchased that gold bar for about $2,400 an ounce back then. And today, the spot price is $3,400 an ounce. So you have about a $1,000 gain, or about a 41% increase in value. There's really not much you could have bought a year ago and seen a 41% increase in value. But I would strongly caution against selling your gold for a profit right now. Even though it went up 41% in value, it's going to continue going up in value as inflation continues to be a major problem. I think a lot of people who invest in precious metals understand that holding on to them for the long term is the smart way and the best way to go about it. It's the way to really build and preserve wealth over time. But if you were to sell one of these bars today, you're going to receive anywhere between 5 to 10% less than spot price, depending on where and how you sell them. If you go to a brick and mortar bullion dealer, they might pay you anywhere between 1 to 5% below the spot price for a standard 1 ounce gold bar. If you sell to an online dealer, they might give you a competitive rate as well, and also give you the convenience of insured shipping. But it's best to stay away from private buyers for the most part, because that way you're avoiding scams, potentially getting robbed, things like that. So I would stay away from eBay or Facebook Marketplace, things like that. And I wanted to go over this real quick because a lot of people have asked, like, hey, once I have the gold or silver, how do I sell it in the future if I need to? Well, the best way is to sell it to an actual gold dealer, either in person or online. You can take your pick when it comes to your local favorite bullion dealer. Online, my favorite one is AppMex. But of course, if you sell, you have to think about taxes. This is one of the biggest downsides to holding precious metals as an asset, because when you want to sell them, you do have a pretty hefty tax bill to pay. Long-term capital gains taxes for gold can be 28% compared to a maximum of 20% for stocks or real estate. And if the gold is sold within 1 year, any profit is taxed at ordinary income, which can mean an even higher rate depending on your tax bracket. That's why I think the best case for owning gold and silver, especially for future-proofing your finances, is using it to either trade with somebody else something, like say you want to buy a house and you have enough gold saved and a seller is willing to accept your gold for the house. So then you can avoid, any type of taxes on that transaction by just trading, essentially. That's one way to do it. You could also find a lender, just like these crypto lenders, that are willing to lend you against your metal. So that way you don't pay tax on that money, because you never pay tax on debt or getting a loan. So there are ways to do this, and there are ways to use that gold and silver savings without selling it and paying that 28% tax in the future. Or you can just sell it, pay the tax, and if you made a big enough profit, then who cares? Some people are happy with that amount. So it's all up to you. Well, let us know in the comments if you're somebody who's interested or out there buying a brand new car, how you're affording it, and how much your monthly payment is on that brand new car. And if you enjoyed this video, make sure you subscribe to the channel. And if you don't want to wait for my next video to come out, check out this one on the screen right over here, and I'll see you in the next one.